And welcome back. I am continuing my little series on reader questions. And these are questions I've received and I've written about in my columns. And I think they make for great conversation. And so here we go. I've got another one for you. And this one is from Sharon. And Sharon's question reads as follows. This is just a general type question for us baby boomers. Rule of thumb was always to decrease your stock holdings and increase your safer investments as you get closer to retirement. I'm not following this advice, and I believe it's foolish not to take advantage of today's market. I have two questions. Number one, do you think this advice no longer holds true? And number two, do you think this market is unusual historically speaking? Excellent question, very relevant, not only today, Sharon, but all the time. and I think it's a funny and fun and very insightful question, and here's why. It's always good to question things like this. It's always good to question conventional wisdom and conventional thinking, and especially good to question rules of thumb. Rules of thumb are a place to start, not a place to finish. I'll always remind you of that. So here's the first thing I would say to Sharon's question. I think it is a good idea, number one, to keep some money invested in the stock market or somewhere else where it has the opportunity to grow. Now, of course, most everybody knows that the stock market does not offer really much in the way of guaranteed performance. I mean, you are taking risk. When we talk about growth in the market, we always hedge that or provide a little bit of a caveat, which is the opportunity for growth. So anytime anybody talks about opportunities for growth, that means that there are risks associated, meaning there might not be growth. In fact, there might be losses. In fact, if you want another rule of thumb, here's one for you. Whatever the stock market can give, it can take away. Whatever it can make, it can lose. So if you look at investing in a mutual fund, for example, and that mutual fund portfolio has earned 15% in the last 12 months, well, then that fund could lose an equal amount. So always bear that in mind, that if it's got a lot of potential for growth, then the odds are it's got a lot of potential for loss. But generally speaking, I think it's smart to stay invested in the market long term. Now, the rule of thumb that Sharon was referring to with this question was the concept of becoming more conservative as you get closer to retirement. And the reason why that is conventional wisdom, if you stop and think about it, you don't want, there's a couple things going on. Number one, you don't want to draw your retirement income from something that is vacillating in value. If something is fluctuating, let's just use a simple dollar. If something is fluctuating between $1 to $1.20 and then to 80 cents, or you can use $120, $100, and $80, when you look at that, that's something that is risky to draw from. Because when you go to take the money out, it's very possible that your $100 is only worth $80, and in order to get the money you need to get out of it, you may have to take more than you otherwise would. So that is a risk that is very different from when you're putting money away. When you're putting money away, these ups and downs, the downs especially, even they don't feel good at the time, they actually work to your advantage. If you're buying mutual funds and the overall market drops 30% and stays down for a 2 or 3 year period, while you may be concerned about the overall economy or you may have concerns about the value of your overall account, the fact that everything is 30% off is good for you as you're putting money away and you're buying at a 30% discount. Now, that value or that benefit goes away very quickly when you're retired and you're drawing money from your investments. You don't want to be drawing at a 30% discount. You don't want to have to sell on sale. You want to buy on sale. So one of the things that people look at doing, and this is where the conventional wisdom comes in, is migrating and pushing money over to something more secure, draw from that money for your income, and then keep other money, a portion of your retirement funds, invested in the investments that are going up and down, the things that are more risky, that are vacillating in value, that volatility that we hear so much about in the news and on television. Volatility is fine as long as it's not something that you're drawing from for income. That's when it becomes a dangerous game. Now, there are a lot of rules of thumb out there about how much should be at risk versus how much should be more secure. There's a rule of 100 where you take 100, subtract your age, and that tells you how much of your money should be at risk. So if you are 65, 35% of your money would be appropriately earmarked for growth and 65% not at risk. So that's one way to look at it. There are other things that you have to consider for your individual circumstance to take this rule. Again, it's a place to start, not a place to finish. Take this rule and adjust it to your circumstances. For example, if you have large pensions, if you have other sources of income like rental income, you might be able to take this rule and instead of having 65% protected or more secure, you might be able to make it 50%. In other words, you might be able to have 15% more at risk than somebody else that doesn't have those other sources of income. You always have to consider the specifics of your situation. Now, to the question or the second part of the question of, are things different now? Yes and no. Whenever you are listening to this program, because we archive them and you hear them, my statements today are going to be equally applicable when you hear me talking. Ready? It's always different, but it's always the same. In other words, there will be market drops. There will be market corrections. There will be bear markets. There will be bull markets. There will be a repeat. But when it comes, whatever it is, if it's a bull market, it might be brought on from a very different type of scenario or economic environment that's created that bull market than has happened in the past. Same with a bear market or a continued period of declining market values, or even a sideways period for the market. We could have a period where the market goes sideways and doesn't grow or fall and stays within a narrow range of market value for 3, 4, 5, 6, 8, 9, 10 years. Who knows? It's going to be different. But if we look at this historically, we've had periods that are like all of those scenarios I just described. So the thing that causes it, or the catalyst, if you will be different. If oil falls to $10 a barrel, do you think that will have a strong economic benefit to the United States? Yes. Will it hurt oil producers? Yes. What if oil goes to $150 a barrel like it did back at the beginning of the Great Recession, 2008? Will that affect the economy? Yes. Will that hurt oil producers? No, they'd like that. That'd be good for them. The catalyst for change, the catalyst for what affects our economy and causes our markets to behave in different ways, they come in a variety of packages and are brought on by different circumstances. But the result is often similar to what we have. So to say it is different this time is probably not going to bear out. And we have seen people make mistakes over the years in thinking that it will be different this time. Bull markets nor bear markets go on forever. And so your best strategy is to take this approach and embrace this question. Some money should be in the market, yes, but a good chunk should not be when you're ready to start drawing money for your income. And that will help you to plan stronger for your financial future.